Today, we're going to break down a concept that fuels these massive corporate takeovers and really shapes the entire global economy. It's called the corporate debt waterfall, and it's one of the most powerful ideas in all of finance.
I mean, you see the headlines all the time, right? Some corporate giant snaps up another one in a deal worth tens of billions of dollars. But have you ever really stopped to think about where that money actually comes from? How does a company possibly pull together that kind of cash?
Well, here's the secret. The answer usually isn't a giant vault filled with cash. It's debt, a massive, complex, and honestly brilliantly engineered mountain of it. And the key to understanding how that whole mountain holds together, well, that's what we're talking about today.
It's this powerful metaphor that explains who gets paid first when a company has money coming in, and maybe more importantly, who gets left holding the bag if things go south. You can think of it as the official rulebook for big-time corporate finance.
Okay, so before we start our journey down this waterfall, let's just do a quick level set and make sure we're all on the same page about what corporate debt even is.
At its core, it's pretty simple. A company borrows money, that's the principal. They promise to pay it all back by a certain date, the maturity date, and along the way they make regular interest payments. Simple enough, right? But the real complexity, and where all the action is, comes from the different types of debt.
And this is our map for today. Just imagine cash flowing from the top. The lenders at the very top, the senior loans, they get their money first. Whatever's left over trickles down to the senior bonds, and then so on and so on. The further down that waterfall you are, the riskier your position is.
All right, let's start at the very top, where the water is calmest and the risk is the lowest. This is the world of senior secured debt, and it's almost always provided by banks.
First up is the revolving credit facility, or what pretty much everyone just calls a revolver. The easiest way to think about this is like a company's superpowered credit card. It's there for short-term stuff, like managing daily cash flow or covering an unexpected expense.
A revolver is super flexible. You can pay it back anytime. But that flexibility isn't free. There's often a commitment fee you pay just for keeping that credit line open. And here's a little inside tip for you. If you see a company that's constantly using its revolver, it can be a red flag that its day-to-day cash flow might be in trouble.
Next up, at the top of the waterfall, are term loans. Now, Term Loan A is your traditional bank loan. You pay it off in regular chunks, and there are pretty strict rules. But Term Loan B, that's a whole different animal. It's usually funded by big institutional investors. And get this, the company pays very little until the very end, when the entire loan comes due in one giant bullet payment. The rules are looser, but that final payment is a monster.
Okay, moving down the waterfall now. We're leaving the private world of bank loans, and we're stepping out into the public markets. Welcome to the world of corporate bonds.
And the differences here are absolutely crucial. Bank loans are private deals, and they're usually secured, meaning there's collateral backing them up. Bonds, on the other hand, are public. Anyone can trade them. They're usually unsecured, so no collateral, and they typically pay a fixed interest rate.
The most common type of bond you'll see are senior notes. The key word here is senior. Now, that doesn't mean they're the absolute safest. Those secured bank loans we just talked about are safer. It just means they have priority. They get paid before the next level of debt below them on the waterfall.
And you can see who plays in this space is the huge institutional investors. We're talking pension funds, insurance companies. They love this stuff because they're looking for a predictable fixed income over very long periods of time, sometimes 10 years or even more.
Okay, now we get to subordinated notes, sometimes called junior notes. The name kind of gives it away, right? They are subordinate to everyone else we've talked about. If the company goes under, these investors are way down the line to get their money back. So to make up for that massive risk, they demand, and they get, a much, much higher interest rate.
All right, time to take a deep breath because we're diving to the bottom of the waterfall. This is where financing gets really creative, super specialized, and yeah, very, very risky.
Welcome to the world of mezzanine debt. This stuff is fascinating. It's a hybrid. It's technically debt, but it kind of acts a little bit like equity or company ownership. In our waterfall, it is the absolute last creditor in line to be paid. The only people below them are the actual shareholders, the owners of the company. So why on earth would a company use this? Usually it's because they're maxed out on normal loans, but they don't want to sell more stock and water down their ownership. To attract investors to this risky spot, mezzanine debt often comes with equity kickers. Think of them like bonus lottery tickets that could turn into valuable company stock. Sometimes lenders even get paid with more debt instead of cash. That's a wild feature called payment in kind.
And believe it or not, there are even more specialized tools down here. Things like bridge loans, which quickly fund a merger before long-term financing is ready, or commercial paper, which is super short-term debt for only the most trustworthy companies.
And that brings us to this really specific number, 270. Commercial paper can't be issued for more than 270 days. Why such a random number? Well, if it were any longer, U.S. law says it has to be formally registered with the SEC as a bond. It's just a perfect example of how financial regulations create these very niche tools for very specific jobs.
Okay, we've made it. We have traveled from the safe, calm waters at the top all the way down to the risky, turbulent depths at the bottom. So what's the big takeaway here? Why does all this stuff matter?
This table really just lays it all out. As you follow the journey down, from a revolver all the way to mezzanine debt, you can just see the risk level skyrocket. The lenders change too, from conservative banks to aggressive private credit funds, and the features just get more and more complex.
And that, right there, is why this is also important. By understanding the debt waterfall, you're not just looking at a boring list of loans, you're actually reading a company's story. You can see its strategy, who it does business with, and its real appetite for risk. It's like a roadmap to the financial soul of a corporation.
So, I'll leave you with this final question to chew on. When you see a company loading up on that risky, expensive debt at the very bottom of the waterfall, is that a sign that they're in trouble, that they're desperate for cash? Or is it a sign of incredible ambition, fueling a game-changing move that could totally reshape an entire industry? The answer is hidden in the waterfall.